Kitco News Outlook 2025 is brought to you by Matador. Matador Technologies is bringing gold and real-world assets to Bitcoin.
Welcome back to Kitco News. I'm Jeremy Safran. Well, this year has been a whirlwind for central bank policies. After holding steady in a fight against inflation, G10, or of course the group of 10 central banks, have collectively slashed rates by a staggering 650 basis points, nearly mirroring the unprecedented actions of 2020. Now, my next guest says the message is clear. Global central banks are colluding to prop up the banking system, seemingly independent of actual economic conditions. But what does that mean for the real economy and for you? Joining us to break it all down and share strategies to hedge against volatile inflation in today's environment is Dr. Nomi Prins. Nomi, of course, is the geo-macro economist, best-selling author of many books, including Permanent Distortion, How Financial Markets Have Been in the Real Economy Forever, and Collusion, How Central Bankers Rigged the World. She's also the founder of Prinsights Global, a great newsletter. Great to see you as always, Nomi.
Great to see you again, Jeremy. Thank you so much.
Of course, we got so much to get into, wrapping up 2024. Of course, 2025 is underway, and I want to get to your Prinsights newsletter, the latest one, which is such a great read. I mean, you pointed out that the G10 central banks have collectively slashed rates by about the same amount as during the unprecedented actions of 2020. You have a chart. We're going to put it up on screen here. I want to ask you to break this down for our viewers and take us through what happened this year.
Sure. So, in terms of the physical number, the amount of basis points of cuts that we've seen this year, it's been 650 cuts about, as you just mentioned, and as we wrote about. And that is about the amount that we saw. Of course, it was from a lower level in 2020 in the outbreak of COVID, but in terms of the magnitude, the same amount that we saw back then. And what does that mean? It means that in general, central banks, including the Fed, have colluded, have worked together to reduce the cost of money. Now, this is despite the fact that, particularly in the United States, looking at our latest inflation numbers, we're still running above that 2% target rate that the Fed has set for itself. And that not long ago, actually last year, Powell was very steadfast about not moving rates until they could guarantee that they were below that band. And that, of course, went out the window in September when rates were cut by 50 basis points, and now 25 and 25 at the next meetings that we had through the end of 2024. So what we're seeing here is central banks in this state of inability to really impact inflation as much as they want to or used to sort of position themselves as being potentially able to do, because a lot of other things impact real inflation, from supply chains to geopolitical events and weather and so forth. But they have moved quite substantively. Now, in the last FOMC meeting of 2024, Federal Reserve Chairman Powell did say, look, we're going to kind of see what happens, back to this idea of being data dependent, which the Fed likes to talk about, especially him, and only potentially do 50 basis points of cuts in 2025, given that inflation hasn't gone to where they want it to have gone to. I actually think that's low. I think we're going to see more than that ultimately as the year breaks out, because economically we are facing a global slowdown, particularly in the developed countries, particularly in the G10.
Yeah, you said it best. And I mean, we continue to see it all year. We've been talking about inflation numbers and that disconnect between Wall Street and Main Street. People are really feeling it. And when we look at this new data, I mean, where is real inflation now? I mean, what's the data that you're paying attention to with all these revisions?
Right. Well, I'm looking at not just the main numbers, but digging into them. So if we looked at, for example, November's numbers, we saw a 2.7% increase in CPI. But if you look, beneath that number, 0.5% just month on month in grocery prices. So if you're the average person and you're looking at how much it costs to feed your family, you are being pinched by a number of different basic items, from milk to juice to coffee, which is at all-time highs. And I don't know about you, Jeremy, I cannot live without coffee. And so there are a lot of these things that are basically staples to a family grocery bucket and bill that have remain persistently high.
Yeah.
What we have seen are lower fuel prices, and a lot of that is actually, I think, getting back to some sort of normalcy in fuel prices. But beyond that, rents continue to skyrocket. Housing prices are still near all-time highs, and the basic living expenses of people relative to wages still remains very high. And so if you look at all of that, the economies, the personal economies of people throughout the country and the world are really stretched. And if we look at the knock-on effect of that, we're seeing revisions downward from earlier this year, earlier 2024, and even in the beginning of this year, of what they had been all about a year ago in terms of growth. Growth in the United States is expected to be below 2%. That's not adjusted for inflation, which makes it basically negative. Growth throughout Europe is expected to be less than 1% in Europe, and even less than that in the UK. So we're looking at this combination of slowing growth, higher regular inflation in real expenses for people, and runaway debt. In addition, in terms of what governments have to deal with still relatively high interest payments on that debt.
What happens with inflation going into 2025? I mean, we're entering an unusual time. There's a lot of uncertainty. And of course, we have the political front too. But where do you see inflation going this year for consumers?
I think we continue to see it rising in the basic needs of consumers. I look at one area, for example, in autos, where towards the end of 2024, there have been a lot of purchasing of new cars and used cars, which had sort of been waited upon earlier in the year. And I think people just figured, it might get higher next year. We're just going to sort of lock in. And of course, a lot of the manufacturers and the leasing deals that they can see right now are pushing people to do that, to sort of lock in prices with expectation that things are going to get more challenging in terms of inflation heading into 2025. Why? We are looking at uncertainty in terms of tariffs and in terms of supply chain that feeds things like autos, that feeds things like electronic equipment, that feeds things like parts of the energy supply chain. So people are, I think, expecting and businesses are expecting inflation to rise. And part of that actually manifests in real rising inflation. But also all these factors, I think, will push inflation up as we head through 2025. And that's aside from any extraneous tariff wars. And specific focuses of those wars between the U.S. and China, between some of the countries that China uses to circumvent tariffs to the United States, and whether those will be caught, and a lot of other issues. I saw this very interesting. I had an actually interesting conversation with someone that focuses on traceability of supply chains, who was telling me that $50 to $100 billion worth of products, as it stands, before any new tariffs come into play, that are coming from China or Chinese sort of travel supply chains, have basically been sent back because they sort of need to be re-tariffed or re-examined for other issues. And those sorts of things impact prices and inflation as we move toward this 2025 unfolding.
Yeah, interesting. Okay, let's get back to the Fed for a second, because I found it interesting. I mean, you wrote, quote, "The Fed can't print commodities, build lower cost homes, or open oil reserves, and it can't control inflation." So break this down more for us. Why can't the Fed control inflation by lowering or raising rates?
What we've seen since the Fed and other central banks started raising rates between March 2022 through the middle of 2023 was really a mixed bag. The overall level of inflation did come down, but prices were still increasing. And we sort of dig into what was increasing. Rents were increasing. The cost of health expenses were increasing. Medical supplies were increasing. Groceries were increasing. And fuel or gas supplies increased and then sort of decreased. So, when you look at how inflation manifested, overall it came down. But if you look at the different buckets, prices still remain high and are rising. Just less rapidly than they did in the wake of COVID, where we were coming out of major supply shocks and economic slowdowns and shutdowns. And there was a time period coincident with the Fed raising rates at the time, where inflation came down just because of a normalization of those supply chains. What we're seeing now is much of that has passed, except in commodities. What's interesting about the gold market, the silver and copper market in particular, is there's still actually a dearth of supply coming into the market relative to what the growth and demand will be. And part of that actually is still an overhang from shutdowns during the COVID period. Some of it is the fact that the cost of financing a lot of development and processing of commodities, certainly in those metals, has increased because the cost of money has increased because rates were high. So there's a lot that's going to still work itself through the system, which is why, again, I think rates will be lowered by more than 50 basis points as we head through 2025 in the States, and again, globally throughout the world. We'll continue to see this rate slow down, which will help loosen up some of the expenses of mining. But meanwhile, we still see inflated costs, and we still see more demand coming in for those metals than supply has been available in the wake of COVID. And so we're going to see that manifest in terms of the price of miners, which should go up, and also the price of those commodities. They've gone down a little bit in the end of 2024, but they're still, silver's up 25%, gold's up 25, 27% over the year. Copper's interesting. It's only up about 4% year over year. It's had a steep sort of decline from its May highs, about 20% decline. But I think that's going to reverse itself when we see that we need that supply, and there's that dearth of supply that's going to have to keep up with just regular energy transformation and other demands for copper.
Yeah. It's going to take quite a bit. I think a lot of our viewers will be excited to hear on the metals front. I'm going to get your outlook on gold in a moment, but I want to ask you about debt. I mean, Nomi, you and I have talked about this before, global debt levels reaching record highs. I mean, do you see a reckoning coming in 2025? And if so, how's it going to manifest?
I think we're seeing that reckoning happen in terms of prospective policies to remove the debt ceiling or increase the debt ceiling or whatever in the United States. The last time the debt, even in the United States, was discussed was 2 years ago, and January 2nd, 2025 was actually supposed to be the date at which that debt ceiling would come back into play. And either way, debt has increased from $31.4 trillion 2 years ago, when that conversation was first had, to over $36 trillion. And at the rate that we are going, we should see U.S. debt over $40 trillion by the end of 2025 or early 2026, and moving towards $45 to $50 trillion really throughout the Trump administration if we continue on this trajectory. And that is with tariffs being increased. And that is with where we're at right now in the deficit. That includes, therefore, greater payments on interest. Now, this is something that's happening around the world. I think the pace of debt increase in the United States is actually quite a bit faster than some of the other major countries in the world. But what this means is that the cost of bearing that debt at current interest rates, as it continues to grow faster than economic growth or revenues can come in to combat it, is going to drag on economic growth. It's going to increase domestic and international political uncertainty as to how to deal with it, whether spending cuts for different elements of the economy are enough to dig into the deficit and to combat this escalating debt without efficient growth strategies, which we really don't see much of at the current moment, or sort of more significant growth strategies. And so I think that's going to be an issue. The debt's going to really pull at growth.
What's your view on the U.S.'s government's, ability to finance deficits in the face of these rising geopolitical challenges and the waning global trust, it seems, on the U.S. dollar?
That's a really good question. I mean, it's really interesting because there's been so much talk about how the dollar has stayed strong, and obviously got stronger towards the end of 2024. The dollar's only up 5%. Over sort of an index basket of other currencies, despite all that talk about it being strong over 2024. That way underperforms silver and gold, and it's about where copper is for the year. So it's really interesting that there's this focus, because the reality is trade, reserves, and other means globally of diversifying against the dollar, de-dollarizing, continue to rise. There continue to be more trade alliances between BRICS countries and their There are other allies in the globe that we continue to see right now. For example, oil, which used to be 100% petrodollar denominated in terms of trade, is now about 25%, 25% should be by the end of the year, of other currencies, creating deals to enable that oil to flow in non-dollar terms. And we look at something like the People's Bank of China, and you and I may have talked about this, but it's very interesting because since 2018, they have gone from being $1.3 trillion holders of U.S. Treasuries, of U.S. debt as part of their dollar reserves, to about 750 billion. So basically, have cut in half the amount of Treasury debt that they want to hold, and that's just indicative of wanting to. Not just wanting to, but actually meaningfully diversifying reserve relative to dollar. And of course, they have been purchasing gold at a now new record for 2024 and should continue to be purchasing more gold to diversify that year. And other BRICS countries are talking about having a potential currency that can have some form of gold backing it as well. All of these are de-dollarization methods. And so that's going to continue because any nation, this is just really an economic question to ask is, if you're purchasing debt in a nation, even as strong as the United States, where that debt is only increasing, that deficit is only increasing, and its potential for growth, if you take the stock market out of it, right? If you take stock market investment out of it, but actual true economic growth remains fairly anemic, then you can actually find ways to diversify, and you should find ways to diversify to protect the import and export costs for your own country. And so this is what we've been seeing. And I think this is what we're going to continue to see.
Yeah, it's been a wild trend. You and I, we're going to talk about sound money in a second here, but you just brought up the stock market, and it's kind of a good way for me to pivot because you wrote that this year's Fed pivot to cheaper money despite inflation concerns is one of the reasons that the U.S. stock market has outperformed other markets. We saw a little bit of a sell-off after that FOMC meeting, Powell speaking maybe more of a hawkish tone, and then we saw it kind of come back a little bit. It's been quite resilient. What's your outlook for U.S. stocks going into 2025?
Yeah, I think that initial reaction to Powell talking about being more hawkish, as was actually anticipated. I mean, we all have seen these inflation numbers. It should not have been a surprise that he was going to focus on that as a reason to sort of pivot back from the initial forecasting of potentially more than a 50 basis point cut, which again, I think is still going to happen. But also, I think that he doesn't really know how to deliver words to the market often, and I think there's generally an overreaction to anything he does say. Particularly talks about inflation because there's a fear that maybe there's more to what he's saying than what he's saying or how he's saying it, and that could mean, for example, not even 50 basis points of a cut, but none or something like that. So there was an overreaction, and then about half of that sort of rallied back, within a day or so after he said that. And I think what that's saying is that the way to actually fight inflation, or at least to make money on money, in the stock market, is continue to be invested in it. So even if you have these pullbacks, and even if you have this assessment of what the Fed is saying, overall, the overall effect of money flowing into the stock market, even at these levels, has been to push it up quite significantly over 2024. I see more volatility coming into 2025, and I think the more AI, for example, in fintech that we see coming on board and taking positions in the market and reacting to movements or exacerbating them, we might see more of. But I think overall, we're still going to end the year higher.
Okay. I mean, Nomi, you've often warned about systemic risks in the financial system. You and I have talked about it before. Going into 2025 and continuing that look at the outlook here, what are the biggest warning signs?
So we still see, I think, a misvaluation, I'll call it, of the loans, commercial loans in particular, on the larger banks book. The story has been that it's only regional banks that have been susceptible to these defaults and delinquencies that have been growing in the commercial lending business, right? But the reality is there are so many credit lines and there's so many deals between the larger banks and the regional banks that I still see risk coming into play. And what we also are seeing is that there's a lot of debt that has been accumulated by the small business community. And there has been a thought that if rates come down, we can refinance that debt and we can continue to sort of push forward. That fills into leasing in malls and in buildings and so forth around the country. And the fact that even though rates have come down as quickly and as much as they have from a magnitude standpoint this year, they haven't really moved the needle on medium to long-term loans. We see that the 30-year has just continued to increase in yield, and bonds have fallen. And when we see things like that happen, what it means is that in anticipation for commercial loans to be able to refinance, or the hope at lower levels or levels that will make a difference to their payments and their overall bottom line, won't be manifesting. And I think that's going to weigh quite heavily on the banking system. We may not see that in the first quarter, but I think we're going to see that more as the year goes by, especially if there aren't any cuts, or there are a few cuts, or maybe only 25 basis point cut in the first quarter.
Yeah, interesting. Okay, let's keep on the bank theme because we can zoom out a little bit. We recently learned that the Bank of England will no longer disclose its bailouts to the public. I mean, where is this coming from, and what does this mean for the public in the UK?
Yeah, that was a really interesting stat that I put up on my X, formerly known as Twitter. It's interesting because this should be transparency in the banking system should have been a lesson from certainly the financial crisis, 2008, and also in general. We've seen a lot of banks in the beginning of last year fail, large banks in Europe, Credit Suisse and so forth, and have had so many issues. And you would think that the UK would, particularly the Bank of England, which tends to be more conservative about these sort of things, would want to continue to be transparent to the public. Or when I say continue, or at least continue being more transparent than they were before the financial crisis of 2008, which they've been pretty good at. So the fact that they've stepped back on that is another indication to me that on a global basis, and a lot of these banks participate in global deals and global financings, are in trouble as well. And they don't want to get into a situation where, for example, they have to provide more quantitative easing to bail out any banks or to liquefy any banks and be caught out for doing that when they have positioned themselves to be more of a regulating central bank than some of the other ones out there. So to me, it signals there is actually stormy weather to come for the UK banking system, and they know that, and they want to get in front of that.
Yeah, it's wild to watch what they're doing there, especially you'd think, as to your point, they've learned a thing or two. It almost sounds like a black swan event. And Nomi, we've talked about this before, but if there was to be a major black swan event next year, where do you think it's most likely to come from? I mean, is it going to be geopolitically, the financial markets, banking, somewhere else?
Well, geopolitically, we can always have that. I think that the Middle East still remains up in the air. What happens between Russia and Ukraine and what happens under the Trump administration still remains to be seen. I think we could see events between the U.S. and China, China and Taiwan, the sort of Southeast Asia area that could be black swans that could escalate from any sort of tariff wars or anything along that nature. I mean, that is still definitely a potential. We also see, for example, in the banking system, that there are increases of delinquencies and defaults. The Fed has maintained its book at just under $7 trillion. It pivoted back from quantitative tightening and really has not done very much to reduce its balance sheet, which still to me means it wants to cushion any banking problems that could come and will if they do come. So these are all areas that can bring risks into the economy and certainly the markets, because the markets tend to overreact, and it gets back to the volatility I was talking about a little bit earlier, to anything that pops up and then sort of work themselves out after the fact.
Yeah, well said. Okay, well, our viewers are often, quite concerned about CBDCs. I want to talk a little bit about the central bank digital currencies because they're accelerating globally, with every original BRICS country now running a CBDC pilot program since the Russian invasion of Ukraine in 2022 and the subsequent G7 sanctions. Cross-border CBDC initiatives have surged, doubling the number of pilot projects. But these digital currencies don't just promise efficiency, they also raise concerns about privacy and control. With unprecedented access to user data, I mean, CBDC systems could reshape how we think about money, payments, personal freedom on a global side. What's the latest developments here, and why are you concerned here, Nomi?
Yeah, that's all happening. And I was in Rio during the G20 and wrote about this in Prinsights. The fact that even though a lot of focus was on the election that had just happened, with Trump coming in, or and sort of Biden leaving, and whether Biden was showing up for his photo op and everything else that was going around sort of publicly at the G20 behind the scenes, there was actually a very interesting meeting between Italy and Brazil, between Prime Minister of Italy and President of Brazil about lots of things, but in particular payment systems. And by payment systems, I mean a global payment system that can ultimately challenge SWIFT and other settlement systems that are more dollar or Euro-centric. And it was interesting that Italy is actually part of those conversations. And one of the reasons for that is that Italy and Brazil have been talking for months about some adaptation of a system that Brazil Central Bank has created and backed, called PIX, which is now used by about 100 million people, but growing very rapidly, just started in the wake of COVID. And that basically connects retail individuals directly to the central bank. Now, not in CBDCs yet, but at the same time, as you mentioned, there are so many pilot programs going on, and one of the pilot programs is behind something called the DREX, which is the Brazil CBDC. China has its own pilot program for CBDC with commercial entities. And so if you have a situation, continue on Brazil, where the central bank is piloting a CBDC-based system and it is owning a payment system that goes down to the retail level, and this is part of a conversation that's taking place between Italy, Brazil, China, the BRICS, etc., then we're seeing all the pieces of what can be not just CBDCs being introduced, which all of those pilot programs have indicated they're poised to do in 25, 26, but also potentially to connect them to systems that go down to that retail level. And so when you get back to issues of privacy, that becomes a real concern, because every element of every action now that is done from a payment basis by an individual can not only be seen by any sort of settling bank that's involved, but also up through the central bank, which takes you up through the government. And if everything's on a blockchain, or in the case of Brazil, they're actually developing things on a Ethereum-based sort of smart contract basis, and let's say those two things even merge, then there's an awful lot of information that follows people all the time. And that is troubling, A, if it's hacked, B, if decisions are made about people or groups of people based on their payment styles. It also can connect into how people are taxed, if they're taxed at source versus taxed at the end of the year in these countries. And that can impact how people manage their own budget. So there's a lot of things that are happening. These are not sort of pipe dreams or things that are really far in the future. They're really manifesting right now on a faster and faster basis that can have true ramifications. They can speed things up, they can speed up de-dollarization, but they can have real privacy and financial freedom types of ramifications.
Frightening. Okay. Are we moving towards then a more bifurcated financial system with Western economies and BRICS nations operating entirely separate monetary systems?
It's an interesting question. There's still the fact that the U.S. is the main reserve currency, and there's still the fact that from a liquidity basis, any large financial institutions operating throughout the world, no matter where they emanate from, need to have a call on dollars in order to be able to remain liquid, do international deals, and so forth. However, yes, we're also seeing more development towards CBDCs globally and payment systems globally that aren't based on having the dollar as the settlement currency, and especially in trade, not having the dollar as the trade-oriented currency. And when you look at the dollar index having gone up again by just 5%, even though I was talking about how strong the dollar is over 2024, we don't see in that index the effects of trade that is happening in a non-dollar manner. And that's still a small amount of global trade, but it's increasing quite substantively. And that's where the BRICS and their allies can bifurcate and are bifurcating from the United States. That said, we are a very interlocked world. I mean, we look at something like rare earth metals, 60% of them are in China, 90% of processing in China. They're in permanent magnets, they're in our phones, they're in space satellites, they're in all sorts of things that defense to individuals use. Even with tariffs on those, there's still international markets for so many things. That's going to mean we're still going to have a certain level of globalization as, yes, we have more multi and bifurcated trade agreements and financial payment systems.
Right. Could alternative assets like gold, Bitcoin, or even cash then become more important as CBDCs become more mainstream as we talk about these issues with privacy, et cetera?
Yeah, it's interesting that our piece about the Fed and the Fed's big lie, which is its ability to actually control inflation, which it can't. We talked about the three ways that you basically circumvent inflation, but also this idea of what's happening in terms of currencies. And one of the things, obviously, is cash, and making sure that if you are in cash, you're diversified across different banks, that you make sure that your cash is earning money for you, so that it's in higher yield places, savings accounts or whatever it might be, if you need to get at it quickly, that you have it physically somewhere in your possession, somewhere safe, but where you could get at it if you need it. If systems are down, if there's an issue, that you have that. Bitcoin is obviously had such a tear this year. It's a bit back off of its highs. But I think that if there are regulations or deregulations to come into play in Bitcoin, that could actually be negative, because I think those hurt retail individuals in Bitcoin are wanting to try to use it as a currency rather than just as an investment. So I think it remains more of an investment than a potential currency, because of just how quickly it can fluctuate in value. That's something small businesses and individuals just can't really take on in the regular transactions. Gold, of course, has that ability to, it's physical. So it's out of the system. You can't control it. You can't print it. You can't fabricate it. So it's important, I think, to have gold in your portfolio, to have silver in your portfolio, make sure it's authentic, to make sure it is safe, whether that is in coins, which you can physically have in some safe place at home, whether that's in a vault where you have authentication, that vault has appropriate protections. If you do buy it online, that online service has appropriate protections for physical gold and not paper gold backing whatever you are buying. And I think all of those things are really a way of being external to sort of central bank controlled, CBDC controlled, banking controlled fiat system.
Mm-hmm. Let's stick on the gold theme here, because it surprised many this year, including analysts, with its multiple record highs above that $2,700 an ounce mark. I know I've been talking about it all year long here, these new record highs. So what's your price outlook for gold towards the end of 2025?
I think we're definitely a crack over 3,000. I think we could head towards 4,000 actually by 2025, and that is because of all of these diversifications that we've been talking about. I think central banks outside of the U.S. Purview are going to continue to purchase gold. I think that their countries, therefore, will continue to purchase gold. I think the more conversation will come out about potentially having a gold standard relative to some sort of a global currency, whether it happens next year or not, just the anticipation of it, I think will give a bid to gold. And I think the fact that it has really stuck in so well, gold is not NVIDIA, gold is not a major tech stock. Gold is something that has basically preserved its characteristics for obviously so many years, but also this year we've seen significant outperformance in gold, and I think that's going to continue. There's no reason to assume that central banks are going to stop buying gold. There's no reason to assume it's going to lose its true value or its diversification or hedging value relative to what can happen in the banking system, to what can happen with more debt, in terms of economic growth and so forth. So I do see us heading towards 4,000. I did think we were going to head towards 3,000 by the end of 2024. And I think that some of that was pared back when the dollar sort of spiked up after the election. So we only hit a high of 2,800, but I see that continuing through next year to 4,000.
Yeah, and I mean, it's been fascinating to watch, very resilient. Okay, well, what happens to Bitcoin in 2025? I mean, after a historic year with Bitcoin hitting well above $100,000, and then the eyes on President-elect's promise of a strategic Bitcoin reserve in the U.S., I mean, give me your outlook here. Are we going to see a big sell-off next year? Are we going to see the strategic reserve and come save the day?
I don't think we're going to see a strategic reserve, to take that part of your question first, merely because of that volatility. When we look at how the U.S. Treasury has to function, and how the U.S. has to function, there has to be a certain reliability to prices. And obviously, in a year where Bitcoin has just gone up so dramatically, it's attractive to think, well, that could be very positive as part of a reserve for the United States government, and it certainly decentralizes the control, perhaps, of the U.S. Treasury in terms of creating debt and so forth in dollars. But at the same time, it's just simply too volatile. It's not really a pragmatic solution to the growing debt or the need for strategic growth initiatives in the United States to combat that debt and to combat true inflation. That said, I think that it has caused a lot more awareness in general in the investment community, in terms of individuals, in terms of ETF purchasers that weren't involved in Bitcoin before, or just more tangentially, and kind of hop back in. So you're going to see this, this demand, I think, come back into the market from people that kind of dabbled a little bit, then sort of saw the up thing, thought they weren't really catching it, want to get, sort of FOMO of Bitcoin. But I think, like we saw with a 10% or so drop towards the end of 2024, that can happen very, very quickly. I think we're going to see those as well, because we're not going to manifest a strategic reserve. And even if we reduce the regulations around Bitcoin, there's still going to be a need for them. And so I think there's going to be some uncertainty about how those go down. On the other side of that, you've got BlackRock saying, buy Bitcoin ETFs, we're solid, et cetera. And that's going to bring in some retail. So I think we see more volatility in Bitcoin as well. I think it probably goes below 100 by the end of the year, but I think we can see some extreme volatility around 100 as the year unfolds.
Interesting. Okay. Well, I know that you keep pretty good eyes on the markets. I know that you're a big fan of commodities. We talked briefly about copper, but when it looks at, what other assets are worth looking at this year in terms of this economic environment?
Yeah. So again, copper from supply standpoint, uranium had a bit of a sell-off towards the end of the year, actually throughout the year, on the back of first having had such a pop-up because of U.S. legislation that had been passed in quite a bipartisan manner to enhance the need for domestic supply of uranium and the processing of uranium, and technological advances that basically maximize nuclear power and localize nuclear power. And I think that traded off towards the end of the year. I see that turning around again, because we haven't decided not to use nuclear power. We don't all of a sudden have an abundance of uranium. We only have one opened mine in the United States that's fully functional right now, with a number of others to potentially come online, but these things take time. And we still have the potential of geopolitical risk with respect to Russia, and so the uranium belt as things go on. So I'm saying to those people that actually were involved in uranium or uranium miners, the fact that they sort of traded off a bit towards the end of the year is actually an opportunity to really invest in them for the coming year, because none of the underlying fundamental factors have changed.
Yeah, certainly. And we know that our power needs haven't changed at all either with this whole AI community. Okay, let's have a little bit fun here before I let you go, Nomi. If there's one key takeaway that you want our audience to keep in mind for navigating the economic landscape in 2025, what would it be?
It's to keep your eye on the long haul.
Yeah.
It's to be patient with the fact that this is going to be a year of fluctuation. This is going to be a year where your stomach might churn by what's happening in your investments in the market, and sort of geopolitically, and how everything impacts and is codependent. So the best thing to do really is to remain patient, to look at major dips if they are in companies that have solid financials and in areas that have strong fundamentals supporting their trend, to consider adding, but not to freak out and sell with the market if those things are intact, just to maintain a steady course. I think it's what I do. It's what we talk about here. It's really to ignore short-term acute noise and maintain a long-term perspective.
Always sifting through the noise for us. The year of fluctuations. I wrote it down. I like that. Dr. Nomi Prins is a geo-macro economist, of course, a best-selling author and the founder of Prinsights Global, which I recommend everybody goes to subscribe to. Some fascinating insights. Happy New Year, Nomi. Thanks for doing this again, and we wish you the best. Hopefully we'll have you on in the next few months, and we'll see after Trump sits in the White House where we're at here.
Absolutely. Thank you so much, Jeremy, and to everybody at Kitco. Happy New Year.
Happy New Year. Appreciate it, Nomi. We'd also like to thank our Outlook 2025 sponsor, Matador Technologies. They're bringing real-world assets to Bitcoin. You can find out more by going to matador.network. I'm Jeremy Safran. Thanks again for everyone here at Kitco News for tuning in. Don't forget to hit the subscribe button, and we'll see you next time.
Kitco News Outlook 2025 is brought to you by Matador. Matador Technologies is bringing gold and real-world assets to Bitcoin.